Every day, billions of people shop online, send money, and pay bills with a single click. It feels instant. You press pay now, and it's done. But what really happens to your money in those few seconds? Who checks the payment, and how does the system handle billions of transactions every day? Behind every purchase is a powerful hidden network of banks, payment processors, and security systems working in real time, silently powering the modern digital economy. The enormous scale of the global payment system. To understand online payments, we must first understand their scale. The global payments industry is one of the largest financial systems in human history. Every year, trillions of transactions move across digital networks connecting consumers, businesses, and governments. In recent years, global payment systems have processed trillions of transactions worth quadrillions of dollars in total value. Digital payments alone now represent a massive share of global economic activity, driven by e-commerce growth, smartphone adoption, online banking, and financial technology innovation. The expansion of online shopping platforms, subscription services, and digital marketplaces has significantly increased the demand for fast and secure payment systems. The rise of digital wallets and mobile payments has further accelerated this transformation. Consumers are increasingly shifting away from cash toward contactless and online payments, making digital transactions the backbone of modern commerce. Economists expect this trend to continue as more countries develop real-time payment systems and expand financial access through mobile technology. This vast scale makes online payment infrastructure essential to global economic stability. Without it, international trade, online business, and digital services would struggle to function efficiently. The key participants behind every online payment. Although online payments appear simple, multiple institutions coordinate behind the scenes. Each transaction involves several participants, all performing specific roles that ensure money moves securely and reliably. The process begins with the customer, who initiates the transaction using a credit card, debit card, or digital wallet. The customer provides payment details and requests authorization for the purchase. On the other side is the merchant, the business selling goods or services, which needs confirmation that payment is valid before completing the transaction. Between the customer and merchant operates the payment gateway, a secure digital bridge that encrypts payment data and transmits it to financial networks. The gateway protects sensitive information and ensures that transaction details are safely delivered. Another crucial participant is the payment processor. This entity handles communication between financial institutions, transmitting transaction data, verifying details, and managing technical processing. The processor connects merchants, banks, and card networks in real time. Two banks are also involved in every transaction. The issuing bank is the customer's bank, which verifies available funds and approves or rejects the payment. The acquiring bank represents the merchant and receives the funds after the transaction is completed. Finally, card networks provide the global infrastructure connecting these institutions. They manage transaction routing, authorization systems, and financial communication standards. All of these participants work together instantly, forming a highly coordinated system that most users never notice. What happens when you click Pay? The moment you click the payment button, a sequence of complex processes begins. Although it takes only seconds, the system performs multiple verification and communication steps. First, your payment information is entered and encrypted. Encryption transforms readable financial data into coded information that cannot be easily intercepted or stolen. This ensures secure transmission across digital networks. Next, the payment gateway sends the transaction request to the payment processor. The processor forwards the request to the appropriate card network, which then sends it to your bank. Your bank examines several factors, including account balance, card validity, transaction limits, and potential fraud risks. If the bank confirms that everything is valid, It approves the transaction and sends authorization back through the network. This approval travels from the bank to the card network, then to the processor, and finally to the merchant. The entire process typically takes only a few seconds. However, authorization does not mean money has moved yet. It simply confirms that funds are available and reserved for the transaction. After authorization comes clearing, a stage where financial institutions verify transaction details and prepare records for settlement. Finally, settlement occurs, transferring funds from the customer's bank to the merchant's bank. This stage often takes 1 to 3 business days, even though the purchase appeared instant to the customer. Why online payments feel instant? One of the most fascinating aspects of online payments is the illusion of speed. Transactions feel immediate because merchants receive authorization quickly, allowing them to complete the sale. In reality, the actual transfer of funds often happens later. This system works because financial institutions trust each other's guarantees. When a bank approves a transaction, the merchant's bank trusts that the funds will be delivered. This network of trust allows global commerce to function efficiently without waiting for physical money transfers. New technologies are gradually reducing settlement time. Many countries are developing real-time payment systems that allow instant fund transfers between accounts. These systems eliminate delays and provide immediate financial confirmation, transforming how money moves globally. Security, protecting the flow of digital money. Security is one of the most critical aspects of online payments. Because financial data is extremely valuable, payment systems use multiple layers of protection to prevent fraud and unauthorized access. Encryption protects data during transmission by converting sensitive information into secure code. Tokenization adds another layer of protection by replacing actual card numbers with temporary digital identifiers. Even if intercepted, these tokens cannot be used to access real account details. Modern payment systems also rely heavily on artificial intelligence to detect fraud. Machine learning algorithms analyze transaction patterns, identifying suspicious behavior and blocking potentially fraudulent payments. These systems continuously learn and adapt to new threats. Authentication methods provide additional protection by verifying user identity. Many transactions now require biometric verification, one-time passwords, or secure authentication steps. These measures ensure that only authorized users can complete payments. Despite these protections, cybercrime remains a major challenge, driving continuous innovation in payment security technologies. Why intermediaries are necessary? Many people wonder why online payments require so many intermediaries. The answer lies in trust and reliability. Digital commerce often involves strangers conducting transactions across different countries and financial systems. Intermediaries verify identities, guarantee payments, manage disputes, and maintain financial stability. They provide consumer protection and ensure that transactions follow legal and regulatory standards. Without these intermediaries, buyers and sellers would face significant risks. Payment systems would lack accountability, and fraud would increase dramatically. The presence of trusted financial institutions makes global online commerce possible. How payment companies generate revenue. Payment infrastructure is not free to operate. Payment companies generate revenue primarily through transaction fees charged to merchants. These fees support network maintenance, security systems, fraud prevention, and operational costs. Although individual transaction fees are small, the enormous volume of global payments generates significant profits. Payment companies process billions of transactions each year, creating one of the most lucrative sectors in the financial industry. This business model has encouraged continuous innovation, leading to faster processing systems, improved security technologies, and more efficient payment networks. The shift toward a cashless society. The world is steadily moving toward a cashless economy. Digital payments are replacing physical money in many regions as consumers prefer faster and more convenient payment methods. Governments and businesses promote digital transactions because they reduce handling costs, increase financial transparency, and improve tax collection. Digital systems also expand financial inclusion by providing access to banking services through mobile devices. In some countries, mobile payment systems have become the primary method of financial exchange, demonstrating how quickly consumer behavior can change when digital infrastructure is widely available. This transition reflects a broader transformation in how societies interact with money. If this video helped you understand the hidden system behind online payments, share your thoughts in the comments. What surprised you the most about how digital transactions really work? For more videos, make sure to like and subscribe. Thanks for watching, and we'll see you in the next video.